Very good morning, my dear future chartered accountants. Hope everybody is doing great. This is Chinmaya Hegde, and we are doing FR updated problem classes, free classes for the benefit of CFR students. FR. If you are attending this for the first time, the material for these classes are available in the Telegram channel, for which description is given, for which the link is given in the description. Just to make the points very clear, these are not revision classes. I'm not discussing the conceptual part in detail. These are the sessions for updated problems, new problems added in study material, latest RTP, MTP, and suggested answers. To cover those problems, we are doing these sessions. So if you have not prepared earlier, then these sessions will not be useful to you now. And we have finished so far in days 1, in days 34, in days 7 in the previous two sessions. Now we are going for consolidation in days 27, in days 110, and so on. I hope you have prepared for the consolidation concepts. You have done some basic problems at least before you continue this session. So let's begin. Again, I repeat, the material is shared in the Telegram channel. The link for that is given in the description. So if you have the material with you, you can come to this problem. Maybe page number 214 on Index 27. Okay. So hope you got the question now. Let us read it. Basically, what is Index 27? Uh, Actually, this problem is actually not on Index 27. But anyway, what is Index 27? When a company has got a subsidiary, they will prepare two sets of financial statements, one without consolidation and one with consolidation. The without consolidation part, where you show investment in subsidiary, that statement is called as separate financial statements, and that's what is covered in Index 27. Let us read this. Following is the existing and proposed group structure of original parent A Limited. As per the above structure, owners of company A will transfer all their shareholding in company A to new company. This is amusing me. I don't know whether my understanding is correct. I just will give my opinion. It looks like the heading of the problem is interchanged. This is institute question. I've kept it as it is. But in my understanding, it looks like this heading is not proper. It is interchanged. Correct me if I'm wrong. You see what they're telling. First you read this. They tell owners. Under the owners, new company will come. Under new company, company A will come. And under company A, you are having two more companies. Proposed structure, you are having owners. Under that company A, under that company B, company C. You are, and what they tell, under the proposed structure, owners of company A will transfer their shareholding in company A to a new company. So new company is getting added. In which situation? The new company is getting added only in the proposed situation, right? So my understanding, these two headings are reversed. In the sense, this is new structure, this is old structure. So in the new structure, what is the share? Companies, owners are transferring the shares to the company, new company. So new company is being formed in the proposed structure is my understanding. If I am wrong, please correct me. I will correct it in the subsequent classes. Okay, let's read further. New company will issue the shares to the owners in the same ratio of the existing holding company in A, so that they have same absolute and relative interest in the net assets of the group before and after reorganization. So basically, you are shareholders of company A. Now you are shareholders of new company because you have given the shares to the new company and new company has given their share. Effectively, you are the owner of new company and new company is the owner of existing company. That's what happening now. Assets and liabilities of the group immediately before and after the proposed restructuring will also be same. Cost of investment in company A in the books of owners is rupees 10 lakhs. The equity of the company, equity share capital, and other equity attributable to owners as per the separate financial statements of the proposed restructuring is 15 lakhs. After the proposed restructuring, new company wants to record its investment in company A at cost. Determine how it should measure the cost of investments in company A. Just for 2 minutes, go through the problem once more. Okay, so go hope quickly had a glance at it. Let me just explain what they're trying to tell. Existing situation, in my understanding, the old one, existing situation. Some shareholders are there, so many owners, I will say shareholders, and they are having a balance sheet if you prepare. Obviously, it is investments for them. It will come on asset side. Investments in A Limited or shares in A Limited. They are telling the cost of investments in company A in the books of the owner is rupees 10 lakh. So it is 10 lakh. Fine. This is with respect to shareholders of investments in A Limited. Now, what is happening? This investment is being replaced. This investment is sold actually. You can say that. This is given to new company and new company will be issuing shares. So what the shareholders of balance sheet will be doing after the restructure? They will write investments in new company. They will don't write investment in A Limited. So what will be revised structure is going to be shareholders balance sheet. You will be writing investments in. You don't write in A Limited. You write investments in new company. 10 lakhs. Whatever the value. Let's discuss about the value. Uh, and then we will write the balance sheet of new company. So when you write the new company balance sheet, and they will be writing now investments in A Limited, because now the shares are with the new company. This is what the situation which is taking place. Hope you're able to understand. Let's read once more. The cost of investments in A Limit in the books of owners is 10 lakh. I have shown. The total equity of company A, equity share capital and other equity attributable to owners as per its separate financial statements on the date of the proposed restructuring is 15 lakhs. That is company A. Company A, you will have, if you have this company A balance sheets in their proposed in the separate financial statements, that is before consolidation, because company A has got two subsidiaries. So company A has got equity share capital and reserves and surplus, or here we call it as other equity, and that is put together 15 lakhs as per the separate fund statements of the proposed restructuring is 15 lakhs. So they are going to show 15 lakhs in the revised thing. The question is, new company wants to record the investment in company A. New company, this point we are discussing. They want to record the investment in A Limited at cost. How should the cost of investment be measured, determine how it should measure the cost of investments in company A. So investment in A Limited, what should be this value is the requirement of the problem. I hope you understood what is the existing structure, what is the new structure, and what is the different balance sheet will look like, and what is the requirement. Solution, let me read for you, and then we'll discuss what is exactly is going to be the case. In the current case, new company should measure the cost of investments in company A at the carrying amount of equity shown in the separate financial statements of the company A at the date of restructuring. It should be valued at what? At the share of equity items. Your 100% ownership, so you can take 100% of the value. Share of equity. What is the equity value we just discussed? Equity share capital plus other equity, 15 lakhs. Because new company obtains the control of company A by issuing equity instrument to the owners in the exchange of their existing equity instruments of company A. So new company has got the shares, they issued the shares. The settlement of purchase consideration is by issuing equity instruments. Assets and liabilities of the group immediately before of the proposed restructuring will be same. Owners will have the same absolute and relative interest of the net assets of the group immediately before and after proposed restructuring. Hence, new company will measure the cost of investments of company A at 15 lakhs. So basically, a new company being formed which has the same characteristics of the old company. Getting the point, right? New company being formed. Who are the owners of the new company? Owners of the old company. What are the assets and liabilities of the new company? Same, they are controlling the entire assets and liabilities of the old company. Old company will continue, but as good as a company being formed one layer above existing company. But the features of the old company and the features of the new company are same. Did you understand this term? Features of the new company and features of the old company, both are there, but their presence, their functionalities are absolutely same. The new company, who are the shareholder, they were the same shareholder of old company. The assets and liabilities will be same because the new company will control the old company entirely. Their assets and liabilities are same. And the proportionate ownership, in the sense whatever net interest, assets and liabilities are same. Business is same, the shareholding is same, shareholders are same, and therefore what the old company was having, the same thing should be reflected in the new company. Old company equity on the liability side, share capital plus reserve surplus, is showing 15 lakhs, and that should be the investments, cost of investments in the new company, so that when you mix it, when you do consolidation, as on date, the 15 lakhs equity and the 15 lakh investment for new company and 15 lakh the equity for old company, both will get set off, and therefore that will now no longer be shown. Are you able to understand? So the two companies will merge in a sense when you prepare consolidated financial statements. That is the basic principle in uh, consolidation. Hope you are consolidation problems basics before you take up this problem. Okay, so hope you have taken down or whatever it is there analysis. So I'll just quickly show it once more. What is really happening here? I'll delete this part. Hope you have taken down. So basically, existing situation is you are having shareholders and they were controlling old company. Now shareholders will control new company, and new company will control old company. So essentially, it is having same features in terms of ownership, in terms of assets and liabilities. Therefore, same features, which means whatever is the old company's equity, liability side, old company's equity, net worth is the investment, or old company's equity, that is net worth, is the investment for new company. That's what they're trying to tell. So new companies, whatever investment you show is old company's liabilities. So that when you mix it, this will get offset, and this company liability, this company asset will continue, is the requirement of this problem. I hope you got the structure. Let me go further. You can take a quick note of this. Okay, I'll go further. Next one, next problem. Hope you have this in material. Scenario A. Following is a structure of group headed by company A. Company A has 100% in company B. Company A has 100% in company C. And company C has 100% in company X. Let's write diagrammatically so that we understand the structure clearly. Company A is the heading. Company A has 100% in company B. So under company A, company B will come, and it's having 100%. And company also has 100% in company C. Company also has 100% in company C. And company C has 100% company X. So below company C, you are having company X and 100%. This is the structure. Under A, B and C comes. Under C, X comes. Company A is a listed company and prepares consolidated financial statements as per Ind AS. So, company A is a listed company. Okay. Company C is an unlisted company. Company C is unlisted company and is not in the process of listing any of instrument in the market. 60% of equity share capital of company C is held by company A and 40% share capital is held by outside investors. This look like some conflicting, right? Here you are telling company A has 100% in company C and company C 60% of the capital of company C is held by company A and balance 40% is held by outside investors. I think there's let's again I think it looks like there is a mistake in my understanding conflicting, so I'll take this not as 100%. Let me read this as 60% of the capital because that's what this statement says, right? 60% of the share capital of C is held by company A. So let's not make the 100%, let's make it as 60%. Okay, so 60% is held by company A and balance 40% is held by outsiders. So outsiders, I hope you're able to see some outsiders, they are having in company C 40%. Company A does not object to the company C not preparing consolidated financial statements. Whether the company C is required to prepare consolidated financial statements as per the requirements of Ind AS 110. So this is regarding exemption to prepare consolidated financial statements. Ind AS 110 has given certain situations, certain exceptions where you need not prepare consolidated financial statements. So what are those? Let me quickly revise it for your benefit. Then let me uh, answer this part. I'll show you the chart part of that. Okay. This is the exception given by the Ind AS 110. Not Companies Act. Ind AS 110 gives some exception. What are the four conditions where an entity need not prepare a consolidated financial statement? Parent is intermediary. In this case, is parent is intermediary, A is having shares in C and C is having shares in no, company. Second, company A has in C and C has in X. Company A has in C and C has shares in X. So C is an intermediary company. Yeah, parent is an intermediary company and other owners don't object. Who is the other owners? Who is that remaining 40%? Outsiders, they should not object. Equity instruments are debt, not traded in the public, yes, unlisted company, and not filing with any authority. In Indian case, it might be not the case because you might have to report because Companies Act. But anyway, we are not discussing Companies Act. But you are not filing with any authority, and ultimate or any intermediate parent prepares consolidated financial statements. Ultimate authority, company A, that is preparing consolidated financial statements. Exception to this is for investment entities because basically for venture capitalist people, private equity people, they don't have to do consolidation and they have to measure the investment on fair value basis. But we are not talking about the second exception here. So let's see what the institute solution says and keep this chart in mind. It will be useful for you. Okay, company C is partly owned subsidiary. In such cases, company C should inform the other 40% shareholders. I just told you, right? Outsiders should give their approval. So other 40% equity shareholders should be informed about not preparing consolidated statements, and if they do not object, then company C can avail the exemption from preparing consolidated financial statements. If it is a fully owned subsidiary, it is under your control, you can decide. Company C need not prepare. But here company C is also owned, 40% is owned by outsiders. Company A has got 60% stake, controlling stake, but still you have to inform outsiders that company C is not preparing consolidated financial statements. If they're okay with it, then company C is exempted. This is from Ind AS 110 point of view, not from Companies Act point of view. Because Companies Act says otherwise. That point we are not discussing it. Scenario B, assuming the same facts as per scenario A, except balance 40% of the equity share capital is held by company B. Oh, it's not outsiders. This 40% is by company B itself. So this 40%, 60% is by company A, 40% is by company B. Whether C Limited is required to inform other owners B Limited owing 40% of its intention not to prepare consolidated financial statements in paragraph 4A1. In the scenario, company C is 100% held by company A, 60% direct investment, and 40% through equity company B. So they're only doing it, right? Company A directly have 60%, and I am having in B, and B has 40%. So indirectly, I'm having 40%. So company C is not required to inform company B for not preparing consultant statements and can avail the exemption because it's in effect fully owned subsidiary. Direct 60%, through B 40%. So I am only controlling 100%. So company B need not be informed because it's as good as fully owned subsidiary, and fully owned subsidiary does not require approval from anybody else. Hope you have looked at this one. Any doubts? Shall we go further? Okay. Next problem. A Limited and B Limited have formed new entity AB Limited for constructing and selling a scheme of residential units consisting of 100 units. Construction of residential units will be done by A Limited, and it will take all the necessary decision related to the construction activity B Limited. Construction activity. B Limited will do the marketing and selling the related activities for the units. It will take necessary decision related to marketing and selling. Based on the above, who has power over AB Limited? Okay, regarding the power, let me look at the quick definition for you, and then we'll look at this problem once more. What do you mean by having power? What do you mean by having control? Quick chart thing. You look at, if you say I'm having control over another entity, then three conditions should be satisfied. One, you need to have a power, and you need to have right to variable returns and ability to use its power. So what do you mean by you're having power over investee? I'm having power over another entity. That is basically depend by this important. This is the important one. Of course, you're going to design a purpose of this entity. What is the purpose of forming this company? What is the legal structure of this company? That is there, but more importantly, this point. What are the relevant activities of the investee that significantly affect its returns? And how the decision about the relevant activities are made. So for the entity to perform, or for the entity to survive, it has to do its business, like manufacturing, construction or producing goods, or let's say construction materials, paints, chemical. They have to do a lot of industry. And for you to, let's say, manufacture pesticides, the business of the company, if it is pesticides, what chemicals should go in, what is the structure behind it, how many employees should be there, where should be marketed. For the entity to survive, lot of decisions should be taken, and those list of activities are called as relevant activities, and who takes the decision over those relevant activities becomes the controller. Because there are so many activities in the organization, every activity you are not going to decide. Like in the organization, where should the reception table should be kept, at what time the office should open. These things are not relevant activities. Again, the word relevant is very, very subjective, but still, what affects the operations of the company in a larger manner? What determines the direction of the company? Basically, you can say what comes in front of board of directors. They are only essential, important. They are called as relevant activities, and who has the authority over those relevant activities? Who controls? Who takes the decisions on those relevant activities? They are said to have the power. Now, let's come to this situation. Okay, so coming back to this situation, what business they are doing? Who is controlling the decision? Let's make a simple summary out of it. A and A Limited, B Limited have formed a new entity, AB Limited. Okay, so there is one company A Limited, and there's one company B Limited, and together they have joined and formed new company AB Limited. How much shareholding and all they have not given. It's just being formed. And AB Limited is for constructing and selling a scheme of residential units. So what is the nature of AB Limited job? Is construction and selling residential units. A Limited will take necessary action related to the construction. Okay, so construction activities are undertaken by A Limited, and B Limited will do the marketing and selling related activities. So B Limited will do the activities relevant for selling. Now, if you think from AB Limited point of view, what is the relevant activity? Is the construction and relevant activity, or selling and relevant activity? It's like asking you, is production is relevant or selling is relevant? In my opinion, both are relevant, right? How can you tell only production is important? Or how can you tell only selling is important? Both are required. You just produce. If seller is not there, that is not going to help. If sellers are not there, you're not producing, that's not going to help the organization either. Therefore, both are relevant. Let's see what the institute solution says. In this case, both investors have the right to unilaterally direct the different relevant activities. Yes, A will do construction activities relevant, and B will do selling activities relevant. Here, investors shall determine which activities can most significantly affect the returns of the investee, and the investor having the ability to direct those activities would be considered as power over investee. Hence, if the investor conclude that construction related activities would be more significantly affect the returns of AB Limited, then AB would said to have power over AB Limited. Uh, then A Limited would have said to have the power over AB Limited. On the other hand, if it's concluded that marketing and selling related activities would be more significantly affect, then B Limited would said to have the power over AB Limited. So this answer is purely subjective in nature. Many times in the examination and also practically, we always say, right, depends on facts of the case. The decision will vary like that. It can happen in exam also. Just because a question is given, you don't have to give a conclusive answer. You don't have to give a authoritative answer. You can give answer like this. Instead only has given this answer. You can give answer like this, which is scenario based answer, which is situation based answer. When the facts can move either ways, then give answer like this on a situational basis. So what they're trying to tell you this, and this is very essential feature of Ind-AS, essential feature of IFRS. That is not a rule based standard, but principle based standards. The principle here is relevant activities. And how do you define those relevant activities? Not given in the standard. That is left to the judgment of the investors, of the users of accounts. So in this case, construction activity, residential and marketing and selling activities, we don't know which is essential from these facts. So what is the answer is given? The investor should decide which is significant. If construction activity is significant, A Limited will have the control and A Limited will do the consolidation. If B Limited, if marketing and selling is significant, investor should decide, then B Limited will become the controller and B Limited will do the consolidation. If you are not able to determine at all, also in practical cases, then you may say this is a jointly controlled entity or a joint operation, which is discussed in Ind AS 111. Anyway, that you don't have to talk about it. You can just say who has the power among the two activities, whichever is more significant, that person is said to have the power. So we write a situational answer, scenario based answer like this. Hope you got it. I'll move further. So I'm going to the question subsequently faster. Hope you're making a note of it. Anyway, the video, you can pause it, you can make a note, and then you can watch it continue. I'm not waiting for you to read it completely, since these videos will be available in the YouTube also. Hope you're understanding. I'll go further. Next question. A Limited is an asset manager of venture capital fund X. Out of the total outstanding unit of the fund, 10% of the units are held by A and balance 90% of the units are held by other investors. Majority of the unit holders of the fund have right to appoint a committee which will manage the day-to-day administrative activities of the fund. However, the decisions relating to the investments and divestments are to be done by Fund X is taken by asset manager A Limited. Based on the above, who has the power over Fund X? Okay, let me just explain the process again. Let me draw the simple diagram. Okay, A Limited is an asset manager of venture capital Fund X. Okay, there is one Fund X, venture capitalist fund. Of course, the major activity of the fund is to invest. So they invest in various companies, venture capitalists, angel investors. In these new day startups, venture capitalists are essential part of it. Zomato, which has got a recent listing, has funded by many venture capitalists. So they have got various investments in various corporates. Okay. A Limited is an asset manager. Okay. A Limited is the manager, fund manager or asset manager. They manage the funds, asset manager. Out of the total outstanding units of the fund, 10% are held by A Limited. Okay. So if you look at who is the owner of Fund X, 10% of the units are held by A Limited. 10%. So A Limited has 10% ownership, I can say 10% of the units. And remaining 90% are other investors. Okay. Other investors, 90%. Majority of the unit holders of the fund have right to appoint a committee which will manage day-to-day administrative activities. So you will appoint a committee. Majority people will appoint committee which will they take care of the day-to-day activities of Fundex. Day-to-day administrative activities. Day-to-day administrative activities. However, decisions related to the investments to be done by Fundex. These investment decisions are investments of Fundex are to be taken by A Limited. So these investments decisions should be taken by asset manager. They have the authority. Okay. Now here is the question: who has the power over Fundex? So Fundex day-to-day administration activities committee will be doing it. And who appoints the committee? Majority of the unit holders who are others than A Limited. Now, investment activity of Fundex, that activity is taken care by A Limited. Now, the question here is, which is the relevant activity? Is managing investments a relevant activity? And day-to-day operations is a relevant activity. So, among the two, if you make a choice, obviously, investment is relevant activity, correct? Hope you understand. What do you think? Is investment a relevant activity, investing decisions? Or a day-to-day management is an relevant activity which significantly affects the returns of the organization's returns of the unit holders, which affects significantly the returns. That is said to be the relevant activity. Obviously, investing activity, right? And hence we will consider the asset manager to be the power over company. Let's see what is the solution. In this case, A Limited is able to direct the activities that can significantly affect. See, you don't have to write verbatim solution in examination. What gives you good answer is this. You should write this particular technical word can most significantly affect. That is the keyword. Returns of fund X. Hence, A Limited has the power over investee. However, this does not mean A Limited has control over the fund, and consideration will have to be given to other elements of control evaluation, that is exposure to variable returns and link between power and exposure to variable return. What is that? You remember? If not, I'll just show you once more the chart of power. What do you mean by the power? So if you want to have power, if you want to have control, there has to be three elements: power over investing, right to variable returns, ability to use its power. These three components will determine control. So I will say control equals you are having power to direct relevant activities plus uh, exposure to variable returns, that is right to variable returns, exposure to variable returns, and ability to affect or power over a link over power and returns. exposure to variable returns, and link between power and exposure returns, plus link, or that is the ability to generate. This exposure, then ability, a link between exposure and power. These three should be there. Then only you say that, oh, you have control. But the question is not regarding the control, so we are not answering it. The question is regarding who has the power over fund X. Yes, the power over fund X is in asset manager. Now, asset manager A Limited, do they have control? We are not answering it yet, because power is not sufficient. Along with the power, you should understand what is your exposure to variable returns. Are you affected? You're having 10% of the units. What is your incentive? How is your remuneration fixed? Is it a fixed amount, or is it a performance? It's a percentage on the profit, percentage on the turnover, percentage of the clients you bring in. How the compensation activities are fixed. Exposure to variable returns, link between exposure and power. If it is performance as well, are you getting a share of it? So these factors should also be analyzed while making a decision regarding control. But we are not talking about it, because question is only regarding power. And regarding power, we look at relevant activities. Yes, they are having they are having a power, because they make decisions regarding relevant activities. I hope you got the point. I'll move further. Okay, so I'll move further. Any questions still here? Okay, good. Let's go further. Next question. Okay, an investment vehicle. The investee is created. An investment vehicle is created and financed with a debt instrument held by investor and equity instrument held by number of other investors. The equity tranche is designed to absorb the first losses and to receive any residual returns from the investee. One of the equity hold investors holds 30% of the equity, is also an asset manager. Okay, this looks quite so much of information is there. So as and when we read, let's try to summarize in the chart format so that we get a better structure. Okay, an investment vehicle, investee. Okay, investee, an entity, investee, like a venture capitalist, let's say. Investee is created and financed with debt instrument held by investor. So there is one investor who is having money in the form of debt instruments, like debenture holders, debt instruments, debt instruments. and equity instrument held by number of other investors like issue of shares. So other investors, they're having equity instruments. Equity instruments. The equity tranche is designed to absorb the first losses and receive residual returns. So these equity instruments absorb the losses and receive residual returns. Receive residual returns. Actually, that is no much differential factor. That is the regular feature of an equity shareholder, regular feature of an investor or the owner. Because if you have a loss, debt instrument people will not take it. For them, you have to pay fixed interest. Rest of them, be it profit or loss, is for equity shareholders. If it is a loss, equity shareholders should accept it. If it is excess gain, equity shareholders accept it. That's the nature of equity. Anyway, they have given more clarity regarding that. One of the equity holders, in equity investor, holds 30% of the equity is also asset managers. So in the other investors category who is having equity instrument, one of them is having 30% share, and he is the asset manager of the company, asset manager of the investee, asset manager. I'll say MGR, asset manager. So, or I'll just show like this. Okay. He's having 30% share and is also the asset manager. Okay, fine. Let's read further. Investee uses the proceeds to purchase a portfolio of financial assets. So investee, what is they use the money? They receive the money from debenture, debt instrument, receive the money from equity instrument. The money is with the investee now, and they will use it for purchase of portfolio. What portfolio? Portfolio financial assets. They purchase or they invest. Portfolio means across various categories. Portfolio of financial assets. They purchase portfolio of financial assets. Exposing the investee to credit risk associated with the possible default of principal and interest payments. What is that? A financial asset, like they have given loans, or they are maybe purchasing refinanced loans, debt securitizations, or investing in bonds, whatever it is. So basically, they're having the credit risk. What is credit risk? Default risk. You have given the money to Vijay Mallya, forget about return on investment. Return of investment only not happening. Default risk. They don't pay interest or they don't pay principal. Those kind of things. That's what we call it as credit risk. Investee is subject to credit risk. The transaction is marketed to the debt investor as investment with minimal exposure to credit risk associated with the possible default of the assets in the portfolio, because nature of these assets and because equity tranche is designed to absorb first losses. So investee is having the credit risk, and that risk is not to be given to debt instrument, that is basically for equity instrument. That is the regular feature of any business. If company, let's say bank, not able to collect the money, default happens, obviously equity shareholders will suffer the loss, not the loan, not the lenders to the bank. Debt instruments don't take that risk, because that's those the structure is also there. Equity instrument absorb losses, so the credit risk is with the equity instrument. So if investee suffers loss, its equity shareholders will suffer loss. Returns of the investee are significantly affected by the management of the investee's asset portfolio. So the investee, what profit they get, what return they get is depending on this management, this portfolio. So what is the crux of this organization? What is the crux of this business, that is which will affect their significant returns? That is how you manage the portfolio. Who is managing the portfolio? Asset manager, right? Asset manager having 30% share. Let's read further. Returns of the investee are significantly affected by the management of the investee's asset portfolio, which includes decisions about the selection, acquisition, disposal of the assets within portfolio guidelines, and management upon default of any portfolio assets. All those activities are managed by asset manager until default reaches a specified proportion of the portfolio. That is when value of the portfolio is such that equity tranche of investee has been consumed. From that time, third party trustee manages the assets according to the instruction of the debt investor. Based on the above, who has the power over investment vehicle? Okay, so far what we discussed is the structure of the organization. So what is the main principal activity of the investee of the organization is to invest in financial assets. And who makes the decision about the financial asset? Asset manager, up to a particular point. Up to what particular point? Until it is like, for example, if you say balance sheets, let's say debt equity amount is let's say 80 lakhs, debt amount is let's say 20 lakhs, and you have given loan, let's say 100 lakhs. So 100 lakhs loan, 30 is default. So who will have to suffer that loss? Equity shareholders will suffer that loss. 40 is default. Equity shareholders will suffer that loss. But if 90 is defaults, then what do you think will happen? Equity shareholders will suffer default for 80, but balance 10, you're supposed to collect 100 rupees, but you are collecting only 10 rupees, 90 rupees you are not collecting. So who 10 rupees you give it to debt, but balance 10. Okay, let me say that there is a loss of 95. In the sense you are collecting only 5. So if 5, whatever you are collecting, you will give it to the debt. But you have to give 20 to the debt. You are giving only 5 to them. Balance 15 is a loss. You can say a loss like that. Other way of interpreting the same. Loan is 100. Loss is 95 now. So who bear the loss? Equity shareholders. What is the value of equity shareholders? Limit liability 80. So out of 95 loss, 80 is borne by equity. Balance 50, 95 minus 80 is to be borne by debt people. So when it crosses the investment, that's what they're telling. When it specified the proportion portfolio, when the value of portfolio, it's such that equity tranche has been consumed, it crosses the value of equity shareholders, then debt shareholders will have to suffer the loss. In that case, third party trustee, according to the instruction of the debt investor. So debt investor will appoint a trustee and he will take care of the operations. So until that extreme situation happens, the decisions regarding acquisition, disposal, maintenance is by asset manager who's having 30% share. I hope you got the structure of this thing, what they're trying to ask. Now let me read what Institute has given as a solution. Managing the investee's asset portfolio is the relevant activity of the investee. Correct. Asset manager has the ability to direct. Yes, use these words. Ability to direct. Please use these keywords. Ability to direct the relevant activities until defaulted assets reach specified proportion of the portfolio value. Debt investor has the ability to direct the relevant activities only when default happens beyond certain level. Asset manager and debt investor each need to determine whether they are able to direct activities that most significantly affect the investment returns, including considering the purpose, design of the investee, as well as each party's exposure to variable returns. Okay, so again, answer is situational. Asset manager has the ability until defaulted assets reach a specified proportion. So answer in this case is situational, but in the examination you can write in a normal situation, in a normal given scenario, until default happens, or if the we can say the default scenario, if it is not probable in the near future, maybe you can present the answer like that. This answer given by institute is very vague in my opinion. It's correct, but it's very situational. So from examination point of view, you can write this. You can also add this point that default situation, default reaching that significant level, that crossing the equity exposure. If defaults, significant default, if significant default is not probable in the near future, not probable, depending on the structure of the organization, of course. If it is not probable, then you can say that asset manager will have the has the power. Asset manager will have the power. If it is probable, if the entity is having so much of amounts, we don't know how much amount, if the or because of corona and all, if it is probable, significant default is probable, then trustee will have the power over the organization. But this solution just told situational, depending on what the situation of the organization is, what position the organization is, how much exposure they have the entity. Depending on that, you take the call. But maybe for our understanding, you can write down this chart. Significant default, not probable, then asset manager will be having a power. If it is significant default is probable, where the power can shift to the trustee. You can mention like this. Okay, let's go further. Okay, just read the problem. Read the problem. It's coming to me. Read the problem. Okay, let's read. Scenario A. Following is the voting power holding pattern of P Limited. Okay, as and when we read, let's write the chart formats. 10% voting power is held by A Limited. Okay, so we are having B Limited. In B Limited, 10% voting power held by A Limited. So A Limited has 10%. And 90% power is held by 9 other investors, each holding 10%. So other 9 investors, 10% each. So they are having 90%. Okay, this is a voting pattern. All investors have entered into a management agreement whereby they have granted the decision making powers related to relevant activities of B Limited to A Limited for a period of 5 years. Decision making power is with A Limited. So all the decision making power is given to A Limited. So A Limited also have decision making power. Decision making power. Not forever, for 5 years. Decision making power for 5 years. After 2 years of the agreement, 2 years over, the investor holding 90% of the voting power have some disputes. So these people have some disputes with A Limited, and they want to take back the decision making right from A Limited. This can be done by passing a resolution with majority of the investor voting in favor of the removal of the rights from A Limited. So this dispute, when you want to take out with the power, or I'll just write like this, they are having disputes with A Limited, and they want to take out the rights. And if you want to take out the rights, you need a resolution. Resolution with majority of the investor voting in favor of removal. So you need majority voting, right? Majority voting. If a majority people say yes, let's remove it, then he will be removed. Then A Limited will be taken out from the power. However, as per the termination clause, the management agreement, B Limited will have to pay a huge penalty to A Limited. So, if a resolution is passed and if majority shareholder agrees, A Limited will be taken out of its power, but B Limited has to pay. If this majority accepts, then huge penalty to be paid by B Limited. Huge penalty to be paid by company, to be paid by B Limited to A Limited for terminating the clause before this term. Yeah, before the term. Term is 5 years. You want to remove after 2 years, you have to pay huge penalty. Whether the rights held by the investor holding 90% voting power are substantive. So you have to understand these two words. One is a substantive, the other is protective. Now you are having the right to remove A Limited from managing the activities. You have the right to remove them. You have the right to take out from them. The right to resign, whatever it is. Now, you can take out one person from its power. You can, what do you say? You can fire them whenever you want. You have the power. So, can we say it is substantive power? Let me see if I can show you the definition of substantive. Okay, yes. So the type of rights, substantive, you are going to write uh, regarding the decisions about the relevant activities. You have to consider, when you say the power is substantive, substantive means you have complete control over it. That means you have a real power. For that, you should consider the factors. What factors you have to consider? Barriers preventing the exercising it, requires other agreements, benefits accrue to the right holders. So basically, we are telling you have the right. Really do it. It's like asking, in a structure like Indian politics, Indian government, we have prime minister, we have president. Who has the more power? If I ask you, prime minister has the more power than president, but you need all the approval for president, right? Without president approvals, things cannot be continued. For the bill to become act, it will be discussed in the parliament or Rajya Sabha, Lok Sabha, wherever, but for it to become an act, a president has to give approval. So can we say president has the power? No, he has no substantive power. He don't have substantive right, because He is just a, some people also say, no, like a rubber stamp, because he cannot really exercise his power. He has the power, but he cannot exercise it, and he don't have any benefit out of it. He cannot make any direct decisions. His job is just to authorize, like that. A power may be there, a power to remove may be there, but the question to be asked is it likely to be exercised? If can be exercised without much difficulty, without much damage, yes, then you can say power to removal is there. But many times in practical also you understand those will be nature of protective rights rather than substantive rights. See, for example, bank gives loan and bank says if you don't repay 4 continuous installments, we will take over your management. So is the intention of the bank is to take over the management, is it? Is the intention of the bank to run the business, is it? No. Then what is the intention? They want to protect their interest. They want to protect their money. If you don't pay for EMI, a warning, then I'll take over. So my intention is not to take over. My intention is to protect my money. That's called as protective right, not a substantive right. Their intention is not to control the operation. So here also there is a power to remove. So what we are doing now? Okay. So A Limited is appointed as a decision making authority for 5 years. Now, you can you remove before 5 years? Yes, you have the right. But is it likely to be done? Looks like no, because huge penalty to be paid. So when there is huge penalty, will you still go ahead with it? Of course, depends on the facts of the case, but the unlikely, right? It's unlikely because of the huge penalty, barriers to exercise. Huge penalty is there. It's not likely to be exercised and not likely to be used. Rights are there, but not likely to be used means it becomes protective and not substantive. Anyway, let's read what institute says. Investor holding 90% of the voting power exercise the right to terminate management, it will result B Limited having to pay huge penalty, which will affect the returns of B Limited. This is a barrier. Use the word. Look at the word barrier. That is the technical word that prevents such investors from exercising their rights, and hence such rights are not substantive. So basically, we can say that exercising not unlikely, exercise of power to remove, exercise the power to remove, unlikely, and therefore rights are not substantive. Rights are not substantive. A similar word, substantive rights, you will be using it in Ind AS 116 lease. Whether the person who gives on lease has the power or person who takes it on lease has the power. Is it a lesser lessee arrangement or is it a supplier customer arrangement? You do it in Ind AS 116. There use the word substantive substitution rights. A similar situation would come there. If I just have to give an idea, when I give an asset to you and I will say, if it is damaged too much, I'll take it back. So whose under control it is? Other person is using the asset, but I can take it back if it is damaged. So can I say I'm the one having the control of the asset? No, I'm not having the control because my intention is not to take the asset back whenever I want. My intention is to protect my asset. So protection right, not a substantive right. So that is called as lesser lessee arrangement, not a customer supplier arrangement. Anyway, you discuss more in days 116. There, you please link this technical term substantive rights. Okay, so hope you got this point. Let's go further. Scenario B. Assume the same facts as per scenario A, except there is no penalty required to be paid by AB Limited. The barrier which we are talking about, that the barrier is no longer there. Now it's interesting. For the termination of the agreement before the state term. However, some more conditions are there. Instead of all investors, there are only four investors holding 40% that have dispute with A Limited, and they want to take back the decision making rights from A Limited. Barrier not there. Barrier not there means yes, they can take out the rights with simple majority. But the problem here is only four people have the problem. Four people having 10% each means 40%. Is it sufficient? That's what they're asking. The rights held by investor 40%, is it substantive? To take back the decision, you require majority. The investor having disputes do not have majority, so they are not substantive. 40%, not majority, therefore not substantive. That's what this solution is all about. Okay, so hope it's fine. I'll go further. Again, as I told you, uh, I'm keep moving to the next questions. You can pause the video, take a screenshot at any point in time you want. This video will be available in the YouTube anytime. Therefore, uh, I'm not giving the time for you to write it down. You can write down anytime later. Let's focus on discussion and understanding. Okay, fine. Scenario A: an investor holding 30% of the voting power in ABC Limited. Investor has been granted an option to purchase 30% more voting power from other investors. However, exercise price of the option is too high compared to the current market price because ABC Limited is incurring losses since 2 years and is expected to continue incur losses in the future period as well. Whether the right held by the investor to exercise the purchasing option substantive. So you see, they're having currently 30% voting power. If you take 30% more, it becomes 60%. You will have the control over the entity. The question is 30% likely? Is it probable? Is it likelihood? What is the likelihood? What is the probability? Exercise price is too high compared to the current market price. Maybe current market price is 30 rupees. Exercise price is like 3000 rupees. Just taking an example, too high. Because if market is 30 rupees and you are having the choice to purchase the share at 3000 rupees, why will you purchase 3000 rupees? You don't, right? Unlikely. Remember, for you to call it a substantive, you should look at some factors. And one of the factors is barriers, which will have an impact. Because market price is less, yeah, and the exercise price is too high, it's unlikely the option will be exercised. So you don't go for 30%, which means this option is not substantive. So we don't take that into consideration for assessing the control also. Is not substantive since the option is too high compared to the market price. Assume the same facts in scenario A, except option price is in line with the current market price, 30 rupees, 30 rupees, very close. And ABC Limited is making profits. However, option can be exercised in the next 1 month only. An investor not in a position to arrange the requirement in 1 month's time to exercise the option. Whether the right held by investor is substantive. The right is again not substantive because practicality, if the time available is only 1 month, looking at the first fund situation of the investor, it's unlikely he will going to get that money. He's not getting the money means he will not be exercising this option, and 1 month is not exercising means that option will lapse. So the right is not substantive. Assume the same facts as per scenario A, except ABC Limited is making profits. However, current price is not known since ABC is relatively new company. Business of the company is unique, and there are no other companies in market doing similar business. Hence, investor is not sure whether to exercise the purchase option, whether the right held by investor to exercise the purchase option is substantive. When you are not sure, we are not sure. We don't take it because the company is new, company is unlisted company. You don't know the real value of it, and without real value, you can't really make a decision. So we really don't know. In that case, we just say that on a safest basis, it's not substantive. Right is not substantive because investor is not able to obtain information. So we don't have a guarantee that he will be exercising it, or we don't have reasonable certainty that he will be exercising it. So there is no reasonable information to exercise this power. Therefore, option will be not substantive. This right will not be substantive. Hope you got the point. Let's go further. A venture capital fund is managed by an asset manager who has the right to take the investment and divestment decisions relating to the fund corpus. Yes, that is the nature of a fund manager. They manage the fund. Asset manager is holding some stake in the fund. Other investor have the right to remove the asset manager, or he can be removed. However, in the present scenario, there is an absence of other manager who are willing to able to provide specialized services. Substitutes are not there. That current manager is providing, and the purchase the stake the current manager is holding in the fund. Whether the removal rights are substantive. Again, the answer is not substantive because barriers. You have to consider the factors. Is it possible? I'll just quickly take you through the factors once more. Barriers preventing the exercise requires others agreement. Others also should have a majority approval, and benefits accrue to the right holders. You have a barrier, you don't have a substitute because the person who is coming should also not offer the service, should also acquire some holdings because he's having some stake. So the person is coming in should do the activity, should manage the fund, and should purchase units from this person. You also need to subscribe to the units, so then you need to have money for that. So no substitutes, barriers are there. So we say that this rights are not substantive. Okay, so these rights are not substantive. uh, it will affect the operations of the fund, and ultimately returns also is substitute. The answer is there is no substitute. There is no substitute, and hence these are not likely to happen. The rights are not substantive. Okay, let's go further. ABC Limited is a manufacturer of branded garments and is the owner of brand X. Okay, let's write down. There's quite a few company and all is coming. Okay. So ABC Limited is the manufacturer of branded garments. So ABC Limited is the manufacturer of branded garments, owner of brand X. Okay. So owner of brand X. PQR Limited has entered into an agreement with a franchisee agreement with ABC Limited to allow PQR Limited to set up a retail outlet to sell the product of brand X. Okay, so PQR Limited has got the franchisee agreement. So ABC Limited has given a franchisee rights, and PQR Limited will sell the brand X in the retail outlet. Sell the brand X in the retail outlet. So basically, ABC Limited will manufacture and PQR Limited will sell in the retail units. Sell in retail. Distributors, basically distributors. As per the agreement, PQR Limited will set up the retail outlet from its own funds and decide the capital structure of the entity, hire employees, the remuneration, select vendors for acquiring capital items, etc. So they make their independent decisions regarding starting of that company, to get the loan, speaking to the bank people, maybe hire employees, have your own managers, maintain your own structures and operations. However, ABC Limited will give certain operation guidelines. Okay, so ABC Limited will also give some operational guidelines. Operational guidelines. Like interior of the retail outlet, uniform of the employees, and such other guidelines to protect the brand name of ABC Limited. Whether the rights held by ABC Limited are protective or substantive. So actually the answer is protective. Let me tell you with an example. This franchisee agreement is very popular in, let's say, Pizza Hut. You have seen Pizza Hut stores. Lot of outlets are there, right? Many times a Pizza Hut or a KFC, Cutty Zone, lot of brands are there, you know it. They have the outlets, but the outlet is not actually owned by Pizza Hut. So what they do, they give the franchisee to you, let's say Mr. X. You are the owner of the business. Pizza Hut, I will supply materials to you, use my brand name, you start the outlet, you pay the rent, you pay the employee salary, you take care of the operations, you decide everything, but brand name will be us. So to protect my brand name, I will decide the uniform of the employees. I will decide interior design within that, because when they're sitting, they should feel like they have come to the Pizza Hut only. They want to maintain that standard consistency over across segments. You see that any outlet you go to the Pizza Hut, you see always uniformity there. You don't feel like I've come to different person's outlet, right? You feel like I'm going to Pizza Hut only. But the actual ownership of that outlet may not be Pizza Hut. I mean, it's not a Pizza Hut. I'm just giving an example. Franchisee model, how it works. Maybe KFC, maybe Burger King, similar thing. Cartizone. Cartizone, one of the person I've worked with, so I know the structure, how it works. So the Cartizone people, they provide the vegetables, they provide the all the operation support they will provide, but control is not with them. But they put some restrictions. Hoardings, you should put it outside. You should follow this color pattern. You know, advertisements should be there. The hoardings, bulbs, lights. some banners, some standees should be there. Sometimes they only provide those things also, but does not mean they control the operations. Whom to appoint employees, how many units to be produced, when should be holiday, when not a holiday, to where the money comes from, whether you take the loan or you put off the money out of your own pocket. Once the profit comes, how will you withdraw it? Operations is left to you. It's your management, but because they want to maintain the consistency and want to protect the brand, they put these restrictions. So these restrictions are no circumstance, under no stretch of imagination, is controlling the operations of the organizations. You are the franchisee holder, you are the owner, you take their support. So these rights are supportive in nature, and these, protective in nature and supportive in nature, and not substantive in nature. A very, very practical scenario. Hope you got what point is there. You can read through this point. Uh, the ultimately it's not protective rights. It's not substantive rights. It is protective rights. Okay, I'll go further. An investor holds 45% voting rights of an investee. Remaining voting rights are held by thousands of shareholders, none individually holding more than 1% of the voting rights. None of the shareholders have any arrangement to consult each other, to consult any of the others, or make collective decisions. Whether the investor holding 45% of the voting right have power over investee. This is where Ind AS different from AS. The IFRS, International Standards, Ind AS, focus on principles rather than rules. As we use commonly, substance over form. So, for you to have power over another person, accounting standards would have told you, or normally would have always told you, have majority more than 50%, more than 51%. But we don't look at that in Ind AS. We look at the facts of the case. Like in this case, what is the fact? You are having 45%. So if you look at rule based, a 45%, can you take the majority decisions? No, 45% you cannot take it. But look at the facts. Remaining people not having more than 1%, so at least minimum 55 people should be there. It might be thousands of people. Reliance has lakhs of people. So only with 45% can you make the decisions, can you control the activities, can you say I have dominating power in making decisions, in passing resolutions? The answer is yes. Because remaining 1%, remaining 1%, remaining 55% held across many people, none of them not even having 1%. So even if you take 1%, 55 people should be there. They don't have any collective agreement, and they don't consult with each other. And if you take a company like Reliance, it's spread across world actually. So if AGM happens, do you think they will come? Even if it is by remote, even if by electronic medium, do you think they will vote? The answer is no. Substance over form. Even though you're having 45%, looking at the practical aspects, this 45% is practically sufficient to take majority decisions, to have majority resolution passed in your favor, in your decision favor. Therefore, even with 45%, you can say you have the power. Principles, facts are important than rules. That's the basic nature of index. So, on the basis of the absolute size of the shareholding, investor, and relative size of the voting rights held by the shareholders, relative size, meaning in comparisons. In fact, Mukesh Ambani has got only some 20%, I think, maybe less, but definitely is most powerful person, you can say. So it's more likely. See, use the word. It is likely. It is more likely. Use this word Absolute size 45% you're having. Relative size of others less than 1%. You're having more, others are having less. Investor would have power over investee. Or you can say investor need, we can say it seems appropriate, it's reasonable to conclude. Use the words like this: it seems appropriate, or it appears the investor having the power. It seems appropriate to consider the investor having the power. It is reasonable to conclude that investor with 45% having the power. Please use these terminologies: reasonable, seems, appropriate, so that you are not giving authoritative answers. At the same time, you are modest also in your answers. Anyway, let's go further. ABC holds 40% voting rights in XYZ Limited. Remaining voting rights are held by six shareholders, each individually having 10% each. Whether the investor holding 40% would have the power over investee. Look at this situation. You're having 40%. Don't make the decision just based on your percentage. Look at others' percentage. Others are having six shareholders, 10%. So if all six shareholders come together and make a decision, it will be against you, right? So it is less likely. Don't make a conclusive words. It is less likely ABC Limited will have the power, since size of the number of shareholders is less and not so high. Additional fact circumstances also to be considered to determine whether ABC Limited has power. Additional circumstances like additional facts like maybe uh, to make the decisions, 40% is sufficient. To make some relevant activities, 40% is sufficient. Or the managing director who look after the company will be appointed by ABC Limited. So if the questions are, if the facts are like that, it may be that even with 40% you can have the power. But this fact, what is given, one person having 40%, six-person having 10% each, a person having 40% is not authoritative. We cannot say conclusively that yes, or we cannot say with high probability that he will have the power. But instead of six shareholders, if there are 60 shareholders having 1% each, then ABC Limited having 40% is more likely. We never give answer. In the yes is, I mean, we never give answer in the sense we don't go authoritatively. We don't go by rules. We go by principles. So if 60 shareholders are there having 1% each, it's unlikely, right? 60 people coming together and voting against ABC Limited. So practically, in substance, ABC Limited with 40% would be sufficient to take decisions. But six people are only there. It's unlikely ABC Limited can take the decisions on their own without consulting others. So you cannot say that ABC Limited have the power. So we can see it's unlikely ABC Limited will have the complete power. Okay, let's go further. An investor holds 35% of the voting rights of investee. Three other shareholders each holding 5% of the voting rights of the investee. So 35, 1%. Then 5, 5, 5. Three other shareholders. So 35, 5, 5, 5. So 50% together. 35 plus 15, 50%. Remaining voting rights are held by numerous other shareholders, none individually holding more than 1% of the rights. Small shareholders. None of the shareholder has an agreement to consult any other to make collective decisions. Decisions about the relevant activities of the investee require the approval of majority of the votes cast at relevant meetings. 75% of the voting rights of the investee have been cast at the relevant shareholders meetings. So to make the decisions, you need to have majority. You need to have majority. But looking at the history, all 100% of the people are not voting. Democracy also, all 100 people, all 100% of the people don't vote. And how many people vote? Like Indian share, that's also very high actually. 75% of the voting rights have been casted. Now, looking at the history, looking at the data, everybody is not taking place in the voting. Only 75% is voting. Now, with 75, can you take majority? This person, whether investor voting right, has sufficient to give the power to that relevant activities. 35 out of 75, is it majority? What percentage? 35 out of 75. 46%, right? I think it's not crossing 50%. In this case, active participation of other shareholders are at recent is indicates investor would not have practical ability to direct relevant activities unilaterally, regardless of whether investor direct relevant activities because sufficient number of shareholders in the same way as investor. What they're telling. Active participation of other shareholders at recent shareholders meeting indicates investor would not have the practical ability to direct the relevant activities unilaterally, so you cannot do it on your own, regardless of whether investor has the directed the relevant activities because sufficient number of other shareholders voted in the same way as the investor. Okay, so whether the investor voting rights are sufficient to give the power, the answer is no, because 75% of the people are only voting and 35 out of 75 don't really contribute to the majority, and therefore and other shareholders having 5% each, if they vote against you, 15%, 15 out of this is 35 and this is 50, and remaining people who are voting are I think 25, total 75. So if these people vote against you, you may not be able to make the decision on your own, so you say that you're not having the authority. But you can also say what happened in the past. In the past, is it more likely that these people are in likely to be in favor of you? Then you can say you have the power. But looking at the facts of the case, having 35%, you cannot make that decision unilaterally. Investor would not have the practical ability to make the decision unilaterally, and therefore he is not the investor having 35% don't have the power. Next. Investor A and two other investors each hold a third of the voting right of an investee. So investor A and two other investors hold a third, mean one third. Investee's business activity is closely related to investor A. In addition to its equity instrument, investor A also holds debt instruments that are convertible into ordinary shares at any time for a fixed price. Okay, let me give the facts now. So investor A is there and other two investor, let me call B and C, having one third each in entity, some entity, investee, one third each. So investor A has one share, B has one share, C has one share, one third. And investor A business activity is also related. Investor A business activity is relevant for activity of investee. So business activity is related. Business activity is related. In addition to the equity instrument, A also debt instrument. Oh, A not only equity instrument, it also have debt instrument, meaning like debenture, bonds, and that too not a pure debt instruments that are convertible. Convertible. So investor A having one third in equity shares, having convertible debt instruments, and business is related. So many points. Conversion rates are substantive, they're only giving. That means they're likely to be exercised. If converted, investor A would have 60% of the voting rights, one third, and you're having 33%. If debt instrument becomes equity, it will become 60% of the voting rights. Investor A would benefit from realizing the synergy because in business is related. If the debt instruments were converted to ordinary shares, whether A has the power or investee, answer is definitely yes. You have equity instrument, you have debt convertible instrument, and business is closely related. So, are you likely to exercise your voting rights or conversion? Yes, you have the benefit of business getting closure. The rights are substantive. That means the excise price, market price are reasonably closer. And it will gives you the majority power. And majority power, if you do, does it help you? Yes, you can benefit from realizing synergies. So all these circumstances clearly tells you conversion is possible and it is beneficial to you. So we say that you have the power. Investor A has the power over investee because it holds the voting rights of investee together with the substantial potential voting rights and gives current ability to direct the relevant activities. Use these keywords. Ability to direct relevant activities. Repeat with me. Ability to direct relevant activities. Use these kind of expressions in examination so that you don't have a worry expression on the day of exam result. I'll go further. PQR Limited has entered into a contract with the state government to construct a power plant and distribute the electricity generated from the plant to household of the state. Okay. PQR Limited has signed a contract with the government. For this, PQR Limited has set up a new entity, XYZ Limited. PQR Limited was involved in the design of XYZ Limited, decisions related to the relevant activities of XYZ Limited, that is, how much electricity to generate or the price at which units of electricity to be sold to customer, etc., are not determined by voting rights. Whether PQR Limited has the power over XYZ Limited. So here you are telling new company is being formed, XYZ Limited. XYZ Limited will produce electricity and sell it to the households. The price of the electricity, how many units to be sold, those two things are not determined by voting rights. So PQR Limited don't determine that. But the design of XYZ Limited, PQR Limited has structured it. So PQR Limited involved in the design. Accordingly, involvement may indicate, use the word, look at the word, look at how beautifully it is expressed. It may indicate the investor had the opportunity to obtain the rights that are sufficient to give. You have designed, you have structured XYZ Limited. So when you have given the authority, when you are given the choice, so when you structure, don't you think you do what is beneficial for you, what is under your control? You design the structure like that. You structure like 60% of the shares are under your control, something like that. You are designing the structure of the entity, but not a conclusive that. It's not a conclusive answer that you will do that. That's why they use the word it may indicate to give sufficient power. However, the design is not alone sufficient. We should consider other facts and circumstances such as contractual arrangement should also be considered in the sense how long the contract is going to be. If there is a dispute between the company and the government, how the dispute will be readdressed. If there is a change in the cost, how the compensation and loss going to happen. If there is a accident, who will bear the loss. So a lot of contractual factors to be considered. Based upon only those circumstances we can decide whether PQR Limited has control over XYZ or not. Anyway, so this answer says a situational answer depending on the other facts and circumstances about the decision of power. Okay, let's go further. An invest is only business activity as specified in founding documents to purchase receivables and service them on a day to day basis for investors. Following is the relevant fact pattern. Servicing on day to day basis includes collection, passing on principal and interest payments as they fall due. Upon default of receivable, investee automatically puts the receivable into investors an agreement separately as agreed separately between investee and investor. The only relevant activity managing the receivable upon default because it is the only activity that can significantly affect the investee's returns. Managing the receivables before default is not relevant activity because activities before default are predetermined and amount only collecting cash flows as they fall due, passing them to the investor. Whether investor has power over investee. Read the prompt once more. Okay. The question is this: who has the power? This is typically the structure of a asset restructuring companies. You would have seen debt securitization or Surface Act, something like that. What is happening? Your asset restructuring company, you collect the money from the lenders, so the borrowers. You collect the money from them and you give it to your investor. That's all your job. How much amount you collect? When do you collect? They are predetermined. How much principal? How much interest? They are predetermined. But when will you come into play? What is your real service? What is real business? The only relevant activity is if there is a default. If the person who's supposed to make the payment, let's say, if borrower did not pay an EMI, be it businessman or individual, then what do? We go to their home, we take some positions, and means we blackmail them. I mean, we don't do that, but we follow up them. Maybe we if there is a security attached, we auction it, some legal procedures. So only that is what is the major activity if there is a default. So managing the receivables before default is not a relevant activity. So that they only have given it. So is it going to be, is investor having a power? The answer is yes. So in this question, design of the investee ensure investor has the decision making power only in case of default. The terms of the agreement between the investor are integral to the overall transaction. That's fine. Therefore, the terms of agreement together with the foundation documents lead to the conclusion investor has power over investee, even though investor takes the ownership of receivables only upon default and managing the defaulted receivables outside legal boundaries of investing. Anyway, you get the power only when there is default. But that is the purpose of floating that organization, and therefore investor has control power over investing. Okay, I think some more problems need to be solved. Okay, good, very good, no problem. Hope you have understood this point. Okay, so we'll stop at this point, my dear friends. Quite too much today. We have done till problem number, I think 14 or something we have done. Okay, So 14 problem we have done, decent. This is a lengthy chapter. We need some more time. So stop at this point. I hope these sessions are useful to you. Tomorrow we'll continue the sessions, and request from my side. Please make sure you uh, have a reading on these consolidation basics before you take up the sessions tomorrow, like definition of control, protective right, substantive right, investment entity, consolidation procedure. So please have a reading upon before taking up the session tomorrow. So stop at this point. I hope these sessions are useful to you. So come to tomorrow's session prepared. Till then, take care. Have a nice day. Bye bye.